Hello, my name is Doug Greenberg. I'm the president of Pacific Northwest Advisory, and this is August 2023's 5 Slides in 5 Minutes video. Emotions in the stock market have a close relationship. Think of it like a roller coaster. When stocks are rising and your investments are doing well, it's like being on the thrilling high points of the ride. You feel on top of the world. But this can be a risky time, as what goes up can also come down. On the other hand, when the market drops and your investments dip, it's like that stomach lurching drop on the roller coaster, uneasy and anxious. While this might actually be a good time to find opportunities, most investors are in not the frame of mind to invest in the market. In fact, they're looking to limit their losses at the exact wrong time. The best way to enjoy the ride and not get too caught up in the ups and downs, a diversified portfolio. It's like having a safety harness on the roller coaster. By spreading your investments, you're less exposed to wild swings, keeping your emotions more in check. If you're unsure about how to balance things, ask a financial advisor who can help you strap in for a smoother ride. Oil prices are currently trending upward, and the incline seems steep. A brief recap. A barrel of oil that was $70 and gas pumps charging $3.50 a gallon have now soared to over $80 per barrel and nearing $4 for gas. What's behind the surge? Largely, OPEC Plus, spearheaded by Saudi Arabia, has decided to put a lid on their oil production. While this price range may suit Saudi Arabia's fiscal aims, the global eyebrows are raised about the ceiling of this surge. An escalation to $100 per barrel or $4.50 at the pump could be an alarm bell for our economy. The ripple effect? Almost everything could come with a heftier price tag, leaving our wallets lighter and potentially stunting economic growth. Delving deeper, this scenario isn't a mere short-term anomaly. The global appetite for oil is not just on a recovery path post-COVID, but zooming near record highs. Many might find this surprising, especially in an era striving for green energy, sustainable investing, and carbon neutral goals. But let's face it, our world's backbone still heavily rests on fossil fuels. Combine this stock rocketing demand with an underfunded and stigmatized fossil fuel sector, and you've got the perfect storm for escalating oil prices. The bottom line, fossil fuels, despite all global transition efforts, remain a pivotal, albeit intricate, force in our energy dialogue. Consumer spending is showcasing a promising trajectory. Even when adjusted for inflation, real consumer spending remains robust. If we focus on the annual percent change, represented by the blue line, we see a consistent growth around 2%. Now, while the monthly data might appear erratic, partly due to changing seasonal patterns and possible discrepancies in government data adjustments, the core trend stands firm at 3%. What's striking in this resilience amidst fluctuating inflation rates? By evaluating nominal spending, this trend does vary, largely mirroring inflation movements. As inflation dipped recently, so did the rate of nominal spending growth. Yet, consumers have remained active, adjusting expenditures in line with inflation dynamics. Looking ahead, the spending horizon seems bright, fueled partly by areas where consumers still exhibit pent-up demand or evident spending needs. The U.S. economy is undergoing a noticeable shift, with economists projecting a robust upward momentum. Key indicators suggest a strengthened U.S. economy with predictions of reduced unemployment and an extended period of elevated interest rates by the Federal Reserve. A particularly telling sign is the revised expectations for Q3 GDP growth rate. Initially forecasted at a modest 0.05% in July, experts now anticipate a growth rate of 1.8%, signifying a significant uptick in economic activity. Some economists are shooting for 5% plus over this third quarter. In tandem with these positive developments, the bond market is also set for notable changes. Projections for bond yields, particularly in the 2-year Treasury yield, have been adjusted upwards. By the end of 2025, this yield is now anticipated to reach 4.82%, a jump from the previously estimated 4.65%. All these shifts underline a more optimistic economic landscape with heightened activity and stronger market confidence. This is a phenomenal slide that I wanted to include to highlight 30-year returns versus 1-year returns. So when we reflect on investment returns, it's vital to understand the interplay between short-term and long-term outcomes. Visualize the S&P 500's rolling 30-year return since 1950, depicted by the blue line, juxtaposed against the yearly returns for each of those 3-decade periods marked by the orange bars. What's instantly clear is the volatile nature of yearly returns, while the 30-year trajectory remains relatively stable. Here's the truth. Short-term returns, whether they soar or plummet, might elicit emotional highs and lows, but they don't drastically reshape the bigger picture. So while a single year might bring exhilaration or despair, it rarely, if ever, derails a long-term strategy, unless, of course, one makes impulsive decisions leading to irreversible damage. Investing is inherently punctuated with peaks and valleys. Some years might witness almost every strategy flourish, while others might challenge even the most robust plans. Moreover, depending on various factors like asset type, methodology, or global region, results may vary widely. And let's not forget the ever-present market concerns. One year might be marked by fears of further decline, while the subsequent year could raise alarms about over-accelerated growth. It's a constant tug of war, but here's the golden lesson. While it's human to fixate on immediate results, true investment wisdom comes from recognizing that it's the long game that truly counts. To thrive in this domain, patience isn't just a virtue, it's a cornerstone. Thank you, and please let me know if you have any questions.